is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today I'm here with Andrew Romans, general partner of 7BC Venture Capital Fund. 7BC Venture Capital is a global venture capital firm that invests in innovative founders addressing significant societal changes through data-connected software. They offer strategic support, a vast network of investors and large corporations, and a unique LP in residence program. Andrew, thank you for joining us.
Hey, Hal, good to see you. Thanks for having me.
Great. So where are you calling from today?
I'm in Austin.
Great place to be. So am I. Glad to catch up with you. So for those who don't know, we had a podcast several years ago, but can you give us more about your background? How did you get to this place?
Yeah, sure. So I started off as an entrepreneur, actually working in the enterprise software industry in Silicon Valley, New York, and Austin, kind of rotating at the beginning of my career. And then I spent most of my days in Silicon Valley, where I raised about $300 million for my own startups, managed to get to an IPO, M&A, some epic failures before I switched to venture capital. And I ran the Founders Club, which was a venture capital equity exchange fund, for about a decade. I spent a few years helping startups raise venture capital funding. And then I got into secondaries, which was an evolution of the Founders Club, where we were helping founders of growth stage companies sell some of their shares, getting the best possible deal on the secondary market. So without waiting for that M&A IPO. And then it's been about 12 plus years that I've been running vanilla, normal venture capital funds.
And so what drove your shift from being an entrepreneur to venture capitalist?
The honest truth is I remember the first meeting I had with a VC for my first startup in the 90s, and I thought, I wouldn't mind having that guy's job. I thought it was just pretty interesting and exciting. And in a way, when you're a VC, you get to kind of be an entrepreneur doing multiple startups at once. And unless you're Elon Musk, that's pretty hard to pull off. So it's just it's a love calling passion thing. I just kind of was attracted to doing it and I enjoy it. And it's an interesting, complex topic. And, I'm a little intellectual and written some books and taught a class at university about it. And so I like venture capital.
Well, so what challenges did you face in founding the Rubicon Venture Capital, and how did you overcome those?
Well, a big challenge is raising LP capital. Let's be honest. Unless you are, the inventor of the Mosaic web browser, Mark Andreessen, or, Peter Thiel, PayPal, or Joe Lonsdale, Palantir, these guys made so much money on their exits that they would invest like 160 million of their own money as basically a super angel, then bundle that into a fund and immediately raise money from institutional investors. When you're like an emerging manager founding your own venture capital fund, it is difficult to immediately access pension funds, endowments, multifamily offices, sovereign wealth funds that are writing 50 million, 100 million, $25 million checks into your fund. And so the big challenge of starting VC funds is how to find someone to invest in your VC fund. And there's only so many people who know and love you, already. So that I would say has been the honest biggest challenge.
How was living in Europe and knowing multiple languages influence your investment style?
So a big kind of big bang asteroid hitting the planet change in my life was moving from the suburbs of New York to Paris, France at the age of 16. And I went to a bilingual high school that had over 40 nationalities in it. So girls that I was dating, guys that I played soccer with, friends were all different countries. Americans too, Brits too, but a lot of different countries. And so I think, for me, if I meet somebody from Kuala Lumpur or Sao Paulo, I'm like, yeah, dude, why not invest in our fund? And your family runs that part of the world. When we fund a company in Austin or Silicon Valley or New York or Vancouver, we can introduce them to you and your parents and your family and help them grow their business. So I'd say we've always had a fairly international perspective on that. And then some of my books have been translated into a bunch of other languages. And so I get invited to be a keynote speaker at some country somewhere where they're growing their little kind of innovation Silicon Valley, Austin, economy. And you meet some people, and some of them like what we're doing, want to be part of the network, and we raise more LP capital and grow the network.
Right. Well, you've been working with startups for many years now. What's your advice for those corporations and governments before they want to engage with startups? What do you tell them to do?
So for governments, I think that they should do what the Israelis did very early on, what the French, what the Brits, what the European Union does, is provide tax incentives to encourage people to invest either directly in startups or to invest in funds, and they have a flow through to get that tax benefit. So in the UK, if you invest £100,000 into a startup or a VC fund that funds a startup that qualifies for the Enterprise Investment Scheme, EIS, you don't have to pay ordinary income tax for the previous tax year on that money. So, you might save yourself 50%, 50,000 pounds if you invest 100K into a startup. So that's like right off. It's like I'm buying Bitcoin for half the price. And the worst thing that happens is I lose 50K, even though I invested 100K. And then you pay zero capital gains on the gain if it works. So they're really motivating large corporations and individuals to participate. And they exert pressure on the large corporations, like the 40 biggest corporations in France. We want to see you invest in VC funds that are backed in French founders, either here at home or anywhere in the world, which I think is the right policy. You don't want to confine all your Israelis or all your Saudis to only be in Israel and the Kingdom of Saudi Arabia. You want to set them free to go out and land in Austin or Silicon Valley or New York and conquer the world and be the world dominator, category leader, and then create connectivity between your home base and the big innovation hubs like Silicon Valley, New York, Austin, and others. You
Go
asked
ahead.
about the large corporations, and I'll be good and give a short answer, but I did write a book, Masters of Corporate Venture Capital, with 50 case studies of large Intel caps, Microsoft M12, and all these kind of guys. And why do they do it? And the short answer is if you're a large corporation, you can either be a victim of technological change or you can be a beneficiary of technological change. And if you think you're going to capture all the AI activity that's happening or all the internet and all these changes with internal people in cubicles, I can tell you, you're going to be a victim of technological change. If you do what Cisco did and Telefonica and you invest in, they sent a friend of mine to Europe and he invested in 54 VC funds in the first 12 months he got there. And then as an active LP, anything those 54 European VCs and Brits were investing in, they had direct front row seat access to that innovation. And if they started doing business with them, they could buy 10% of the company with their corporate venturing program. And then their M&A team could buy the company. So Cisco wouldn't be Cisco without their corporate venture capital program. So I think governments that want to make sure their country is not left behind, then why don't they have a Nokia or a BlackBerry or an iPhone, Apple in their country? They should sharpen their pencils and put tax incentives in and get their corps to, one, invest in VC funds and start cherry picking investing directly. And then they should get an M&A program and start buying companies to acquire innovation, following the playbook of John Chambers at Cisco.
That's good advice. So how do you think the media shapes the public views on venture capital today?
You can blame the media for a lot of things. I don't know if you can really blame them too much for being civilian ignorant about venture capital. I think one of the problems is that like the actual vernacular terms for venture capital is that venture sounds like let's go on an adventure. And this is going to be casino high risk capital. In German, it's Risikokapital, and that means risk capital. French, it's Capital Risque. It literally says risk on the can of soup, and that is such a load of crap because the truth is, you give me a fund size, I'll give you your fund strategy in a spreadsheet that says, all right, I got $10 million fund. It's a small one. I got $1 billion fund. Take out the management fee. That's 2 times 20. your 8 million or your 800 million of dry powder divided by how many investments at seed or pre-seed or late seed or growth. And if you invest early, you need a lot of companies to neutralize that risk. If you drill for oil once in Bahrain or Qatar, you might spend a lot of money and not get oil. If you drill 50 times in Bahrain, you be hitting some oil, I think, you know. But what do I know? If you invest later stage, you can afford to be a lot more concentrated. So the truth is, they should get that word risk off our goddamn, business. I think investing in the stock market, unless you're going to jail with Jeffrey Epstein and Gordon Gekko in a fast car and you are breaking the law, it's hard to deliver alpha. Ask Bernie Madoff. Unless you're cooking the books, that's not easy to do. I don't care how much robo trading fiber optic cables you got. When it comes to real estate, there are things like volcanoes and two amazing presidential candidates that can screw up your great plans and things can happen. Whereas in venture capital, hurricane, volcano, bad presidential candidates, whatever, you take out that management fee, you divide it by, I don't know, 25 investments, 70%. And then you say, I double down in my winners, concentrating 30% of my money, or flip that, invest in a whole bunch of companies, 70 of them with 30% of your capital, and cram 10% of the whole fund in your top winner and 10% into number two and have 50% concentrated. There's a different strategy to meet every personality, skill set, industry that, in my opinion, removes the risk. The issue I have with most VC is, what was the cash on cash multiple that you make from investing into it? And how damn long did it take to get my money back 1x? And how long did it take for it to completely wind up? And then ask yourself, was that multiple worth the lack of liquidity and the amount of time it took to get my money back? And for some funds, they deliver it quickly. They're doing something smart in the secondary market, and they somehow are making 7x, 10x. Other funds are so big that for them to make a 2x multiple on a multi-billion-dollar fund is some pretty good compensation for the GPs.
Great. So, what's a key lesson you share with students wanting to enter the VC world? It seems like there was a time when everybody wanted to be a VC.
Yeah, and I think that ebbs and flows, and you expect, it's going to come back in style and out of style. It goes out of style when they can't raise the money, in my opinion. It should go out of style when the pre-money valuations are too high in a frothy market, but that just seems to be when they pile in, the strategy is buy Bitcoin high, sell it at the crash. Buy it Bitcoin high, sell it at the crash. And that's a guarantee that Bitcoin will go up and down, but up and to the right over the long term. So the long-term Bitcoin buyer does well. The guy who buys at the peak and sells at the crash, not doing so well. And that's where I've seen a lot of tourists come and go over kind of my 30 years of experience in the venture capital tech world here. And, I have advice on how to get into I have a little chapter of my new book of how to get a job in venture capital, where I basically show historically what it was like in the 90s, where they came from. And then over my experience, the guys that just go right from MBA, get a job as an associate, or the guys that get a job as an associate at emerging managers like ours, and what career paths look like for either generational transformation at the small or big fund, or make your mutiny, make your offshoot, and attempt to raise, your first fund. So I examine all of those. Again, I'm afraid of answering one of your questions where I've written a book, on the topic, but feel free to maybe drill down with specifics, Hall, if you want to go double click deeper on anything there.
Well, yeah. So, what inspired you to write Masters of Raising Venture Capital, and how is it different from the previous ones?
Yeah. The first book, McGraw-Hill gave me this title I'm still not crazy about, The Entrepreneurial Bible to Venture Capital, Inside Secrets from Leaders in the Startup Game. I wrote that largely when I was running the Founders Club, where we had so many portfolio companies doing the equity exchange with each other and then getting into secondaries that was like a baby that just had to come out. People were telling me like more than twice a day, you should write a book. And so I kind of said, well, if I'm going to tell the John Kraft story of how he founderized employees when he failed to meet payroll 22 times before the IPO, I said, let's tell the John Kraft story directly from John Kraft. So I would interview John, who's a friend of mine, founding CEO of Pandora, and he shares lessons learned. And then I kind of, try to get it down to 200 pages where there's a lesson learned that with an actionable, replicable piece of advice. Like I find it's no good for a VC to write a vanity book of, yo, look at me, I invested in Amazon, boom. Look at me, I invested in Nvidia, boom. Maybe a bad example because that one took so long. I was just saying, this is something that you could do at home. Like kids, try this at home type advice. So that was kind of book one, which was a collection of stories, but organized from like fundraising to legals to M&A to company building value, stuff like that. Book two was Masters of Corporate Venture Capital, which I had to cut from book one because it was getting too long. And then I really dove deep and let like 4 years go by of just meeting over 400 CVCs, corporate venture capital executives, to get the wisdom of why to do it, what are the typical pitfall mistakes that most of them fall into, what would you do differently, and what's the best cockpit settings to run the ultimate CVC, and how to customize it to the needs of each conglomerate or corporate or business, to achieve those goals, where it's a balance of strategic and financial. Book four was Masters of Blockchain and Crypto, where I thought I got to meet all the super connectors and become friends with them if we're going to go into this C-shift change. And then we sort of backed away when the companies are trying to raise too big of a financing round at too high a valuation, and then maybe leave with some cash and start another company without even getting a product into market. And I was like, all right, unless they go back to first principles of entrepreneurship, we're going to take somewhat of a sideline. So we've only invested in companies in that technology that are running the normal playbook. With the new book, motivation to write it was to help. The more founders can be better at fundraising, all the tides rise together, in my opinion. We kind of like a playbook when you get to a certain point of raise enough money to last you 24 months. So what revenue do we have? What are our expenses? What's our monthly burn? And divide this funding round by enough to divide it by 24 months. If sales are flat, we have 24 months of runway. If you grow sales, you can increase spending, and that's expected to happen. When you're 12 months in and you still have a year of cash in the bank, let's have everything ready, deck, financial model, bullet points in the email, the whole thing, ready to go into solicitation with a target investor list of here's all the VC funds, here's the individual partners, and here's the Hall Martin that's going to make that warm introduction for me. And then we just run that process like a military IPO type operation, book building exercise, secure the lead, get all the term sheets, compare them, close that round. And that can take, there's times in life where it takes a day or two, but you expect it to take at least 2 months. And in today's world, I say expect it to take 6 months. So if you were 24-month runway funded, you kick this off after month 12 when you've 4x or 2x your revenue and your second grade top line math looks good and you've hit some kind of milestones. You then raise that bigger round at a bigger share price, bigger valuation when you still had 6 months cash in the bank, and then kind of rinse and repeat until it gets bigger and bigger and bigger. And then there's a lot of considerations around when to exit, and then all the kind of conflicting interests of, does the VC want to exit now and the founder doesn't? Does the founder want to exit now and the VC doesn't? And how do you manage all those? And then understanding the evolution of secondaries and all the good, bad, and ugly bits around what's happening with secondaries. So there's a deep dive on pre-seed, how to get started with nothing. Like that's literally a chapter. How to recruit people, how to get people in that orbit, and go through all those little phases from pre-seed to, kind of accelerators, demo day type stuff, and how to play Y Combinator, how to play Techstars and all that, onto late stage seed extension, whether it's going well or not going well, and lead into cracking that Series A, and then how to make sure you don't fall into pitfalls of foie gras, overfunding, overspending, premature spending, and all the complexities of late stage growth, and a lot of nuances around secondaries for founders, secondaries for investors, how to price it. What's the right amount of money to raise? How should we price it? How should we run that process?
Well, one of my favorite ones was you discussed the importance of understanding when to pivot strategies. What signs should founders look for that indicate it's time to change course?
Well, I think there's some kind of timeless Paul Graham stuff is talk to customers, build things, talk to customers, build things. And he's purposefully saying, don't really talk to investors, perhaps. I think that it's an opinion worth taking on board as well. But if you're, and I'll say it this way, where I would augment Paul Graham's thing, Paul Graham meaning co-founder of Y Combinator, YC, is to say, if the number one cause of death for a startup is running out of money, running out of cash. So do not run out of cash. And where do you get cash from? Government grants, we don't really like those companies too much. So you're going to get your money from a customer or an investor. And the other lever you have is, what am I spending? Can I lower my spending, or can I be disciplined with an operating budget of my spending decisions at the startup, treasury level? How am I spending my money? So I think that time to pivot is when you see that we do not seem to be funding the companies with retained earnings where we have profitable unit economics. Maybe you're spending $100 to get $50 of revenue, like you're handing out $100 bills outside of Costco's in return for $50 bills, and how much longer the other place you get your money is from investors. And so if your investor is like super excited about your negative unit economics, that it costs you $10,000 to get a customer to give you $2,000, a smart VC will eventually stop funding that bad party, right? And so these are indications that maybe we should pivot, right? And figure out something that I can spend $1,000 of my investors' money to get payback either instantaneously or within 3 months or 6 months or 9 months, depending on the industry. And I can deliver within 3 years, 18,000. So my LTV CAC ratio is, I spend 1,000, I make 18,000, and my payback was, say, 3 months or 0 to 3 months. Those sorts of things sounds like you do not need to pivot, and you've stumbled into some sort of product market fit that's good for the customers, and you can, get control of your destiny and become profitable and forget all these annoying VCs. Or you can say to VCs, look at how we could spend wisely to accelerate growth and hire more engineers, tap into more API data sets, and increase average contract value from existing customers. So we're going to land and expand. We should be able to 4x revenue from the existing customer base with a bit more funding. And we can build out a sales team to even further add revenue. And that'll be second grade math for some VC on Sand Hill Road that's willing to put a $75 million check into your company at a $750 million pre.
Well, finally, if you could give one piece of advice to an aspiring founder on the brink of their fundraising journey, what would it be?
It would be to network a lot, but don't become like too much of an event idiot, but develop your network to the point where you can just do favors for everybody else. So constantly do favors for every other entrepreneur you meet. And then when you're getting ready to kick off your next fundraising round, you say, can I get a 30-minute Zoom with you where I'm going to give you a 10-minute pitch in practice before I deal with investors? And I'm not asking you for fundraising. I'm just want to get feedback. And then carve out like July and August or some other time of year to do that. And then after you've had like 100 of these 30-minute meetings, they're going to give you feedback as founders, ideally venture-backed founders, founders backed by the kind of investors that you're looking for. Maybe that's angels, maybe it's single-family offices, VCs, whatever. And then by the end of that journey, they probably are giving you ideas of how to get distribution or augment product or all kinds of things. And then you can add them to your target investor list to, oh, by the way, would you mind making warm intros to me to other investors? Some of those founders might start cutting checks yourself. And so now you're like, hey, the founder of Zillow is an investor and he's smart when it comes to real estate technology. So I would say doing favors for other people makes them want to help you. That's a great way to develop good karma and get ahead. And if you can develop a network of founders that you can do a 2 month fake, mock fundraising process, what will come out of that is probably more than you could have imagined on even product and ideas and great feedback. But at a minimum, it'll populate your target investor list with who can make the warm intros for you. And VCs love to get introduced to a fintech deal from their existing fintech CEO or a cyber deal from their existing cyber CEO.
So where can people find Masters of Raising Venture Capital? How do they get a hold of it?
Well, you can just do a Google search and most likely it'll take you to Amazon. So, that's probably the quickest way for a busy person to buy. It's on Audible, it's on Kindle, and it's in hardback.
Great. And how do they get back in touch with you?
I'll give you my email Hall, if you want, you could throw it in the show notes. Andrew at 7bc.vc. So number 7bc.vc.
Great. We'll put that in the show notes. Want to thank you for joining us today. Hope to have you back for a follow-up soon.
Hal, thanks for having me. Looking forward to seeing you soon.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.